Real estate. As Andrew Carnegie famously said, 90% of all millionaires become so through real estate. I couldn't verify this statistic, so I was hesitant to even bring it up. Without data, a statistic is just as good as the famous Anchorman line.
60% of the time, it works every time.
However, I think it's safe to assume that most millionaires own some form of real estate, so let's just roll with that assumption. The good news is you don't have to directly purchase a house in order to invest in real estate yourself. After all, finding a great deal is competitive, it often costs money to find, and it takes a lot of time. But with advancements in technology, you can buy real estate indirectly through REITs sold on the stock market. Apps like Webull and Robinhood make this possible with as little as $5, and that's much more in reach for the average investor. And by the way, if you decide to get started with one of those apps and want a free stock for signing up, I got links for that in the description. You don't got to use my links, but I'd appreciate it if you did. REITs are structured a little bit differently than other companies available on the stock market, and they have to operate by a different set of rules. One of those rules is that 90% of the taxable income must be returned to the shareholders in the form of dividends. This means that REITs are literally structured so that investors can receive rental income through the indirect ownership of real estate. That's gonna bring me to the focus of today's video, which is one of the most popular REITs around, Realty Income, ticker symbol O. You should never invest into a company you do not understand, so I'll be doing a comprehensive deep dive into this company to see if it's worth adding to your investment portfolio. And there's a lot to talk about. If you're new to the channel, my name's Kyle, and I make a video every week about business, investing, and personal finance. So if you're into that kind of comment, you should like this video and help a guy out. So REITs haven't existed for that long in the grand scheme of things. They were created in 1960 so that the average American could have access to income-producing real estate that used to only be available to large companies and wealthy people. 9 years later, 1969, Realty Income was founded, and in 1994, it went public on the New York Stock Exchange, and it has done nothing but grow ever since. As of right now, Realty Income is by far the largest triple net lease real estate company with over 10,000 properties, an occupancy of 98%, and an enterprise value of about $50 billion, with the next closest competitor being WP Carey at $19 billion. So if you're watching this video and thinking about adding Realty Income to your portfolio, you're most likely looking for a fund that adds not only real estate exposure, but also pays a quality dividend. Great news here because the dividend is core to Realty Income. When you go to their website, you can actually see in the top left corner icon that their tagline reads, "The Monthly Dividend Company." But how stable is this dividend really? Over the last 25 years, the economy has definitely tested it. I mean, we've been through the dot-com bubble of 2000, the financial crisis of 2008, and the pandemic and government shutdowns of 2020.
A lot of their customers are freaked out, waiting to see how low the Dow will go.
Really, you're seeing just broad-based declines across all of the major technology sectors.
And through all of this, Realty Income has not missed a single dividend. In fact, not only have they paid a dividend every month since going public, they've also grown the dividend every quarter for the last 24 years. So imagine that. During all these recessions, when a lot of people unfortunately lose their jobs or have to take pay cuts, Realty Income actually gives a pay raise to its shareholders every 3 months. Again, since going public, the dividend has had a compound annual growth rate of 4.3%, which in itself has beat inflation, but the consistent and growing dividend isn't the only upside to owning this company. Over that same time period, Realty Income has returned 15.1% in total compound annual growth, which has beat the S&P 500 by almost 5%. Obviously not guaranteed to go on forever, but a consistently growing dividend that has historically always paid, combined with great capital appreciation, I mean, what more could you really ask for?
Winner!
But how do they do it, and can they keep doing it is the question. For this, let's take a look at their business model. To quickly summarize, Realty Income purchases single client net lease commercial properties with reliable tenants located just about everywhere. Let's start with the tenants. Realty Income looks for investment grade rated tenants in a strong financial position that are industry leaders if at all possible. I mean, listen to these names. The top tenants include Walgreens, Dollar General, Dollar Tree, Family Dollar, FedEx, 7-Eleven, on and on. These types of tenants are service oriented or offer non-discretionary products at a low price point, meaning they are typically products that everybody needs and they're at a price that everybody can afford. And why is that important? Because they appeal to the masses during all economic environments. Even during a recession, people still need medication and food, for example. Products and services like this have the added benefit of being insulated from e-commerce giants like Amazon, because Amazon, think about it, they likely won't be able to turn profits delivering such low-cost everyday items. For example, most people won't pay a $25 delivery fee on a grocery bill at Dollar General of $37. That's going to keep people coming into the store to shop and keep these businesses going. Realty Income also does a great job of keeping clients diverse. Walgreens makes up the largest portion of annual base rent at 5%, Dollar General at 4%, and Dollar Tree Family Dollar at 3%, but every other tenant makes up 3% or less, with the top 10 clients making up 31% of the rent. This means if any one client were to struggle, it wouldn't massively affect the total performance of Realty Income. And they've also diversified the industry exposure. As of now, the top 5 industries are convenience stores, grocery stores, drugstores, dollar stores, and health and fitness, making up 43% of the rent collected. Unfortunately, Realty Income does own some theaters, which makes up 5.4% of the revenue, and theaters have been a sore spot on the balance sheet since the government shutdowns. Most industries have bounced back, but the movie theater business is taking longer to recover than other industries. In quarter 2 of 2021, only 38% of contracted rents in the theater segment were collected. One reason for the slow bounce back might be the popularity of streaming services like Netflix, Hulu, HBO Max, Disney Plus, and on, right? Right now it's a wonder if the theater industry will ever fully recover. Thankfully though, this hasn't destroyed the overall health of Realty Income because they saw the other industries bounce back. In quarter 2, Realty Income collected 96% of total collected rents. That's with the 38% of theaters, right? So I can't imagine that Realty Income will keep with the theaters at 38.3% rent collection without making some sort of pivot. I'd imagine they'd either demolish and redevelop these properties or maybe sell them off. However, I did scan through the Q2 earnings call transcript and found that at least right now, they're sitting tight with the theater assets, and they believe the industry will bounce back. Currently, all theaters are open. So we'll see what happens. I mentioned locations. Realty Income's properties are also strategically located in all 50 states, Puerto Rico, and the UK, the largest concentration being Texas, the UK, and California, making up 28%. The diversification benefits of being that spread out are obviously, they're self-explanatory, but I most wanted to highlight is that the expansion into the UK makes up 9% of the revenue right now. And this expansion is a solid move in my opinion and makes me believe that growth can continue for a long time since there is no doubt a lot of buying opportunities in other countries. But it's not just the diversification of tenants, industries, and locations that make Realty Income so stable. Stability also comes from the long-term triple net lease structure they have with their tenants. And why is this important, and really what is that? A triple net lease puts the burden of rising property operating expenses onto the tenant. To stabilize these rents even further, the weighted average lease term, or WALT, for current clients is roughly 9 years, so the rents are set for some time to come. Usually though, stability comes at the cost of growth. After all, risk is always inherent in growth. Roughly 2/3 of earnings growth comes from external acquisitions. In 2020, last year, even during the government shutdowns, Realty Income still acquired $2.3 billion in new assets. And through the first 3 quarters of 2021, they've acquired $2.2 billion more, on pace to beat last year. More earnings should mean more profit, which means a higher dividend, which means upward pressure on the stock price. That's how Realty Income has done so well with dividend growth and total returns. And even more great news when it comes to growth. In quarter 4, 2021, this year, they're expected to acquire REIT, which is another triple net lease REIT with a very similar business model. This is gonna add roughly 3,700 properties to the total assets, bringing them to that 10,000 properties I mentioned earlier, just further diversifying the holdings and strengthening their position. For example, before the acquisition of REIT, 7-Eleven's made up 5% of Realty Income's portfolio. However, after the merger, 7-Eleven exposure will be reduced to 3%. The less concentration, the better, in my opinion, especially in the case of gas stations like 7-Eleven's. I don't know what's gonna happen to gas stations with this general push towards electric vehicles, but I think most people would agree less concentration in this sector is a good thing right now. Another move by management recently, aside from acquiring REIT, was to split off their office space, creating a separate holding company they've currently named SpinCo. I love this move because in my view, office space is a dying real estate segment that's probably going to need to be repurposed into something like apartment buildings, or I really don't know. I mean, the pandemic has pushed remote work more into the mainstream, and with advancements in technology, I only see this becoming more and more the standard. I actually found some numbers on this in a recent Upwork survey. 17% of remote workers, that's nearly 1 in 5 people, say they would rather quit than go back to working at the office. And I don't blame them. Commuting to work, dressing up to sit in a cubicle, and engaging in trivial small talk with people you probably don't like is a nightmare for a lot of people. And let me know your thoughts on office space in the comments. I mean, would you rather find a different job than have to go back to working in the office? I'm curious. To sum it up, Realty Income has shown to be a well-run company that performs great in the face of economic turbulence. The dividend pays consistently, it grows, and it's all backed by long-term net leases and a solid business model. Real quick, I'll just show you the numbers in my current portfolio. I currently own 45.68 shares with a yield on cost of 4.29%, paying a current dividend of $10.78 every month. As long as the dividend is at or above 4%, I'm gonna continue adding shares to my portfolio. I think recently in the last day or two, it's actually fallen below that 4%. But of course, this is just my plan, so be sure to do your own research before making your own investment decisions. If you're still here, hit that like button, and if you'd like to support the channel, come check out the Patreon to pick up my dividend track sheet and receive stock alerts whenever I buy or sell anything. And have a chat with me over on the Discord. But that's gonna be it for this one, guys. Thanks for watching this breakdown, and remember to invest at all times.